Some of the loss mitigation options available within a mortgage company. Well, one, loss mitigation, understand, that's the term that we utilize. Loss mitigation, that is the mortgage company mitigating their loss, any option they offer to prevent the foreclosure that's going to save them some money. You have two paths down loss mitigation, options that allow you to keep the home and options that don't allow you to keep the home. People need to understand, options to prevent the foreclosure do not always mean keeping the home. But I deem those very viable options and very good options for some people. One is because it lets you control the process. If it looks like you can't keep this house, at least let's do it in a controlled manner to where we are choosing how to sell it, we are choosing the deed in lieu, that we are working through it in a controlled manner. You've got some control over this aspect of your life that has been kind of going out of control. The other thing is it is good for the neighborhood to have this happen in a controlled manner. If we are able to prevent that foreclosure and to do a short sale or to do a deed in lieu, anything other than having a home foreclosed on that block is better for that neighborhood. So we pursue either of those options with clients. The biggest thing is that you have to know who owns or insures your loan to know what your options are going to potentially be. And then you also have to be very honest with what the current situation is. You have to know, am I in a long-term situation or am I in a short-term crisis? If it is a long-term crisis that has no clear time frame that you can see where it's going to be able to be resolved, then keeping the home may not be an option. It'll depend on how severe the crisis is. But for example, if somebody has been permanently disabled and returning to work is not an option, that's a long-term crisis. So what we have to look at now is what income is coming in. Is there any? Because if the only income is coming in is zero and we're waiting on a disability application, federal disability applications, I don't care if they tell you that they'll have a response in 6 months. That does not happen. No. They may come back with their first question in 6 months, but your first denial is going to come 12 months later, and then you might get your second denial in 18 months and a couple of years. I mean, that system has improved a little bit, but I still say 12 to 24 months. If you get it within 12 months, you are lucky. 24 months is really what you're looking at, because a lot of these cases end up in court, and the court systems are just really backed up with disability cases. So whenever clients come in and say, I'm permanently disabled, but I filed my disability application, I say win. And if it's been within the last 12 months, and we don't have a court date, then we don't really have a way to bank on that as a short-term solution. That's really something that is going to be longer term, and we have to look at then, do we have a way to support this house without that income? Because we can't bank on that. And if we don't, then we need to be looking at options to prevent the foreclosure without keeping the house. If it's a shorter term crisis, if we've had a job loss that's been temporary and we're now back to work, but we're back to work for less money, or any of those situations where it's a much shorter term, where I need to go on sick leave, or I'm on sick leave for a surgery, but I've got a return to work date, or I know I'm returning to work after this period of time, those are things that are much shorter term that we could potentially work something out with a mortgage company. Some of the options that you see out there. One is a special forbearance. This allows a suspension or reduction in payments for a set period of time. This is called the UP program. You'll see at the bottom there under Making Home Affordable. This is for people, UP program is specifically for people who are on unemployment. If you apply within a certain time frame of becoming unemployed, you could qualify to have your payments reduced or suspended for 3 to 6 months. In Michigan, if anybody is on unemployment, they should not do UP. If they are on unemployment, they should first be evaluated for Step Forward. Because under this program, any payments that are reduced or you're allowed not to pay for 3 to 6 months still accumulate as a delinquency. They're not forgiven. You still owe that money. They're just saying, we'll hold off on collecting this money from you for this set period of time. But at the end of that set period of time, we want to see what's going on. And Right. We expect you to either be able to pay us or to have some kind of income to where we can work out a repayment plan or a loss mitigation or some kind of other option. But under Step Forward, their unemployment program will actually keep you current. So that program is much better for anybody if you qualify for it in the state. You'd want to do that. A repayment plan, I'm sorry, just completely skipped over that. Repayment plan, this is usually set up where you have an increased payment for a set period of time. Usually do not see these plans go over 18 months. It's actually rare to see them go over 12. But 18 months is really the longest that you'll typically see. If I see one over 18 months, truthfully, I don't know if I've seen one survive over 18 months. I mean, the rate of failure over 9 months is huge. So you normally don't see them over 18 months because it's almost guaranteed to fail. It's just really difficult to maintain a higher payment for that extended period of time. So you don't see too many repayment plans, but sometimes you will. With people who have been off of work and then gotten back to work and they've returned to very good income. The mortgage company may offer them some kind of repayment plan, and that could be an option for them, but the longer the payment plan is, the less likely it is to be successful. It just gets really difficult to maintain. Loan modification, this is the most utilized workout program anywhere, I would assume in the nation, because it's just huge. But this is where the mortgage company, depending upon, again, the type of loan you have, is willing to look at modifying the terms of your mortgage to create a more affordable payment for you. So they're looking at possibly reducing the interest rate, possibly extending your term. That means taking your mortgage from a 30-year out to a 40-year. Or if you're 5 years in to your 30-year mortgage, putting you back out to 30 years. The other thing they could do is potentially set aside a portion of your principal balance. And I mean set it aside, I don't mean forgive it. Once in a while you will see forgiveness, but I'll tell you that's just really rare. But they could set aside a portion of your principal balance. So what they could say is, okay, you owe us $100,000. We're going to only calculate your payment based upon 80. So obviously you're going to have a lot lower payment because they're only calculating it on an $80,000 loan and not a $100,000 loan. But what happens is when you come to the end of your term, of your 30-year mortgage, you are going to owe this $20,000. You have to understand it doesn't disappear. You basically have created a balloon of some kind. The thought process as to how this works and why this is beneficial is because, it gives people long enough time to where hopefully in that period of time they'll be able to get it paid down and potentially refi that 20 back in. But for right now, we're dealing with the fact that their income has reduced significantly and we need to get this payment down. The payment for the Making Home Affordable program, HAMP, Home Affordable Modification program, is based on 31% of your gross income. And I say gross income, so it does not factor in your child care and your gas and your lights and your food budget and all that stuff. It's 31% of your gross income. So that can be very difficult for people who have a lot of other expenses. Daycare is really the big one. I mean, that could just eat people's income up so huge. Child support, exactly. Those things are really big that can make it look like you can afford more than what you really can. Unemployment is not viewed as income for a modification because it's considered, time limited. It'll depend on the lender, but I usually don't see them allowing more than 3 on. 3 is usually the most I see on the lifetime of a loan, and there usually has to be at least 1 year in between them. And FHA requires that your hardship be different. That you can't come back and have the same hardship, have the same thing that caused you to get behind again. But I mean, some lenders won't allow for multiples, but I'm saying some lenders will, and the most I've seen allowed is 3 in the lifetime of a loan. Moratorium, for people who deal with RD loans, on the direct loans, the ones that are serviced by the Centralized Servicing Center, they do have a moratorium program where the Centralized Servicing Center, before you fall delinquent, if you know there's going to be a problem, they can suspend your payments for a period of time. That is an option with them. We don't come across too many RD loans in our area, but other areas I know do. So that is a potential option. But those are sometimes difficult. The moratorium can be difficult to get because a lot of times people don't come to you until they're already delinquent. And once they're already delinquent, centralized servicing center doesn't want to offer the moratoriums. And the centralized servicing center loans, those type of RD loans, are unable to be modified. Yeah, they're completely unable to be modified. You cannot get loan modifications on RD loans that are serviced by the centralized servicing center. It's a point of frustration and contention right now. And we were not able to, we attempted to advocate for that, but you know, Debbie Stabenow is the chair of that committee. She would be the one that we'd be advocating to, but the Farm Bill kind of took everybody's energy for quite a while in that committee, and you weren't able to get through it or anything. But that is, if anybody's looking for a point of advocacy, that is still out there as the only government loan program that is unable to be modified, and it would take legislation to allow them to be able to do it. And our senator chairs that committee. So. Just a little bit more specifics on the Making Home Affordable program. It was initiated in an attempt to slow foreclosures. Fannie and Freddie were required to participate from the beginning because the government basically took over and subsidized Fannie and Freddie, so they were required to participate. Other lenders could choose to opt in. But I'll tell you again, like I said earlier, for as many problems with this program, HAMP completely shifted the paradigm of how we do loss mitigation in this country. 13 years ago, nobody, I would call a mortgage company and I would have to tell them what a loan modification was. I would have to tell them that FHA required that they evaluate for a loan modification and that these were the ways they could modify the loan. I mean, you were having to educate the mortgage company, let alone the general public didn't know what a loan modification was, but you had people in the mortgage company who didn't know what a loan modification was. Every single mortgage company had a different application. You know, I had file folders full of the major lenders' applications, and everyone was different. Everyone wanted a different set of documents. The Making Home Affordable program standardized that. There is now a standard application. There's a standard set of documents. It is all standardized across lenders, and that is phenomenally huge. It also defined affordable. Before, and this is what blows people's minds, a majority of my loan modifications prior to 2009 when HAMP went in increased your payment. And that was normal, and that was acceptable, and that's what we expected. We expected your payment to go up because they would never drop your interest rate as low as 2%. There was no giving you 40 years to pay back. There was no setting aside the principal balance. The lowest you could get your interest rate dropped to was the current going rate. So that's why we needed this program, because what happened is when we went from having our subprime loans that were at those 9 and 10%, you know, needing modifications, where I said we could do modifications and drop them down to the going 6%, and that was okay. When it shifted and people started losing their jobs and the people with the 6% mortgages now needed modifications, we couldn't get them modifications because they had the going rate. They had the 6%. We had nowhere to drop them to. And that's what loan modifications were. Loan modifications only dropped you to the going current market rate. So what this program did is said, oh, we have a different set of loans that need modifications, and nobody's able to do that. Lenders aren't able to provide that. What do we need to do? And basically the government came in and subsidized it. I mean, this was a national subsidizing of mortgage modifications across the country. And it was huge. By allowing people to now have their payment calculated on 31% of your gross income. That was never done before. It wasn't based on what you could afford. It was, this is the going market rate, this is what your payment will be. Do you have any money left over at the end of the month? If the answer was no, it wasn't affordable and we were done. You know, you were denied. And also a majority of people had to put money down. You would have to pay your attorney fees up front. If we had gone to an attorney already with a foreclosure date and you had incurred those $1,200 or $1,500 in fees, we would have to put a down payment down in order to get a modification. That's unheard of now. Nobody pays a down payment to get a modification. In fact, most lenders would get in trouble if they made you pay a down payment to get a modification. But that's how it used to be. So perspective-wise, I know a lot of people are frustrated with this program, but when you look at what it used to be like, it's a completely different world. HARP is also a program that exists only for Fannie and Freddie loans. But what that allows is it allows people to refi, and I have up to 105% LTV, but I think that has actually been expanded to where the actual program has no cap, but a lot of lenders have their own internal cap. But basically, for people who say, people who are current on their loan and say, you know, what am I getting out of this program? I have two responses. One, there actually may be a program for them to where if they have a Fannie or Freddie mortgage and they're current, but their interest rate is higher than what the going rate is, but they've been unable to refi because home values have dropped and because of all the foreclosures going on, if they have a Fannie and Freddie loan, they could still refi now to the going market rate because Fannie and Freddie say, we don't care. I mean, typically you can't refi your home if you owe more than what your home is worth because you're trying to basically borrow more money than what your home value is. And through this program, they're saying if it's a Fannie or Freddie loan, that's okay. We'll let you drop that down to the current going rate. You can't get any cash out, but we'll let you drop your interest rate down even though your home value has flipped upside down, just so that you can get the lower payment. You know, it's to provide some payment relief. So that's one program for people who say, I'm paying my mortgage on time, what's the government doing for me? This is one program that the government's doing for them. The other thing that I tell people, and because you'll hear this once in a while, especially if you start talking to family and friends about what you're doing and, you know, about the programs that are out there to help people, they always say, oh, you know, I should just not pay my mortgage, you know, so I get some help because government's not helping me. Every mortgage foreclosure that is prevented is helping you. Because if that mortgage is not foreclosed on, that helps your property value. If that mortgage is not foreclosed on and those taxes keep coming in, that helps your neighborhood. So that's how I always explain it to people is every time we stop a mortgage foreclosure, we're helping you. Whether or not you've been through foreclosure or not been through foreclosure, whether or not you're getting any of these official programs or not, every foreclosure that's prevented in your community helps your home value go up. Because every home that is foreclosed on is going to bring yours down. So these programs actually, I say, are national programs helping everybody. HAMP, we talk about that standardized the modification program. There's financial incentives to both the investor and the homeowner. If you get into HAMP, in addition to getting these payment reductions, if you pay your payment on time for the first 3 years, I think it is, or it's 5. It's 3 or 5 years. They'll make a payment towards your principal at the end of the year. It's usually around $1,100, but the government will pay $1,100 down on your principal balance and just do a principal balance payment for you as an incentive to keep making your payments on time. This is the UP program. This is where I was saying if you're unemployed, you can be eligible for the suspension of payment for 3 months. But again, they don't forgive those payments. That's why I prefer step forward. HAFA, this is standardized short sale deed in lieu process. Basically, when we do short sales and deed in lieus prior to this program, it was kind of a crapshoot and a guessing game. Mortgage companies will only accept so much of a loss on a short sale. A short sale is where we're going to sell the house for less than what's owed because we can't, the market's not going to bear the full price of it. I owe $100,000, but the houses around me are all selling for $80,000. There's no way I'm going to be able to sell mine for $100,000. So we can negotiate with the mortgage company to sell it for less. Well, what would happen prior to this program is we would have to list the property for fair market value and not know whether or not the lender was going to accept that offer until offers started coming in, and we just have to submit them and just figure out at that time if they're going to get accepted or rejected. What this program does is basically, as soon as you apply for it, the mortgage company is supposed to order an appraisal, and once they get the appraisal back, they'll give you their bottom line number and say, look, this is the least we'll accept. We have to net this in order to approve the short sale. So it took the guesswork out of it. Now the realtor and the homeowner could say, all right, we can list the house for this knowing we have to net this and it's going to get accepted. Not having to play this guessing game of, I think if we list it for this, we'll net this and this looks like it'll be acceptable maybe, and then find out that it's not. So it kind of took that guesswork out of it for everybody. And it also provided relocation dollars for homeowners. Because again, I'm telling you, they're not giving that $3,000 in relocation assistance because they're being nice. It just shows you how much cheaper it is to prevent the foreclosure and to get the homeowner out than to foreclose on it and have somebody sit in it for 6 months. They would rather pay you $3,000 than to have you sit in that house, because it's all about the money. It's just cheaper. Step forward. So we talked about the updates that are going to be announced tomorrow. But they do have the unemployment subsidy program. So for any homeowner in Michigan who is applying for, who is receiving unemployment, they're now going to do a 12-month look back. If you received unemployment in the last 12 months, or if you are underemployed, and again, you're going to have to look at that percentage when it comes out. But if you can show that you've had a certain percentage of reduction in income, you could qualify for underemployment, and that would qualify under the unemployment. But with the unemployment subsidy, they will pay the amount that you're delinquent on either your property taxes now or your mortgage. And if you have a mortgage, they will then pay half of your mortgage payment for 12 months.
Now, do they pay that amount that you're delinquent right away?
Yes, they pay it right away. That changed. That's not how that was. That used to be different. They used to not pay it till the end. And it was a capped amount at like $3,500. But that changed a little few years ago. And your max total assistance under this program is $30,000 that they'll assist with. But so, if they have to pay 20 up front, then they can only, half of your mortgage payment. If it goes over the 10, you're not going to be able to get the full year. But $30,000 is the cap. But they will bring your mortgage current first and then pay half of your mortgage payment up to $1,000. They won't pay over $1,000 per month.
Is that if you're only unemployed?
If you're unemployed or underemployed. And this is a one-time deal. You can only do one of these programs ever lifetime. So it's one and done, is what they say. Rescue funds, this is basically just a payment. So they can pay your mortgage company, they can pay the county treasurer to help bring you current if you've fallen behind. Again, up to $30,000. Principal curtailment, rescue funds to modifications, we really don't see these utilized too much. Both of those programs, they can, the term sheets will be coming out for them again tomorrow, so you can read over the specifics, but the unemployment program and the rescue funds are really the two that you're going to see the most of and you're going to see utilized. The big thing to know is that these are liens that are attached to the house. So any assistance that's provided, there is a lien attached to the house for 5 years. It's forgiven at 20% every year. So if you live in the house for 2 years and then decide to move or sell, they will have forgiven 40%, but you're still going to owe 60% of whatever they helped you with, and you're going to have to pay that back. So that is something to consider, but most people, as long as they plan on living in their house for 5 years, it's a really good deal. It's 0% interest. I mean, it's basically forgivable. It just sits there. They don't have to make payments on it. They don't have to do anything with it. The lien just sits there and disappears over time.
And not taxable?
No, okay. Not taxable. Some options not to keep the home. Short sale is the big one. This is what you see a lot of going on to where, like I said, I gave the example, somebody owes $100,000, but houses in their area are only selling for $80,000. Then you can apply to your mortgage company for permission to sell your house at $80,000. And the mortgage company can agree to accept that $80,000. That $20,000 is going to be considered forgivable debt. And up until December of 2013, that forgivable debt was not taxable. It is now. There is a piece of legislation in the state of Michigan to try to get your state taxes exempted off of that forgiveness. It has not passed yet. The bill is only up in committee right now. But the big one, we always know the big one is your federal taxes. And right now that is federally taxable, any debt that's forgiven. But a short sale is an option for people who cannot sell their house at fair market value, who cannot sell it for the debt amount that's owed, and fair market value is less, for them to be able to do that. A deed in lieu, if you list your house for less than what's owed and are still not able to sell it, you can do what's called a deed in lieu or request your mortgage company to accept a deed in lieu. And that's basically where you sign the house back over to them. And they take it back and you walk away and you both you both walk away from it. Do not leave a coat hanger because they will charge you for that coat hanger, you know. Because there are some financial incentives to a deed in lieu and a short sale. FHA and the Making Home Affordable program will pay you some money, some relocation dollars. But to get those relocation dollars, you need to leave the home in what they call a broom swept condition, which means everything is removed. They do not want to have to pay one dime for anybody to go in and remove anything of yours. And that includes the garage. I mean, the house and the garage, those things, your stuff has to be gone. Some things to think about or that are typically included in a loss mitigation application. These are a lot of the documents you'd be requesting for people to bring in. They're going to have to be able to fill out a form that talks about their income and their expenses and any assets they have. So when people are looking at what documentation to bring in, you know, they don't have to come in with a prepared budget, but if they don't know what their income and expenses are, they need to sit down and write them down. They need to bring in their bills, but they have to be able to discuss with the counselor what your income and expenses are on a monthly basis with accuracy. Letters of hardship. The mortgage company is going to want a letter explaining what caused you to fall behind. And this should start in the relatively near future. So if we're in 2014, I don't really want to know what happened in 2010. We want to know in the relatively near future, if you fell behind 6 months ago, what happened right around that time? Because some people will go way, way back. And I understand, as a social worker, I understand way back affects what happens right now. Mortgage company doesn't want to read all that though. We want to stay concise and to the point, especially if you're doing step forward. If you're doing step forward, I want it even shorter and conciser because I don't want them questioning anything. I want to be specific and make sure that your hardship occurred right at the time you fell behind. We're going to need pay stubs, social security statements. If you are self-employed, understand that is exceptionally difficult to deal with, but we have a lot of businesses that are. You're going to need some kind of profit and loss. You're going to need a quarterly profit and loss statement, and they're going to want to see a Schedule C on last year's tax returns. So self-employment can be difficult. They're also going to want to see if you have a roommate living in the house, you know, and they're paying you $200 a month and you want to claim that as income, you better be depositing that $200 a month into your bank account so that when you provide bank statements, you can show that $200 a month every month is being deposited. If you receive child support that's not going through friend of the court, you better be depositing it into your bank account every month so you can prove that it's going in. They're not going to just accept a letter and they're not just going to accept receipts that you write. You need to actually show that the money is going into your bank account. Tax returns, they're going to want 1 to 2 years with all attachments. Like I said, especially if you're self-employed, they're going to want those Schedule Cs. Bank statements, 1 to 2 months. A 4506T, this is a tax form that allows them to go directly to the IRS and pull tax returns if they feel as though maybe the ones you turned in are not legit. Mortgage companies will want you to print the actual statement. And you can print the actual statement offline. And you need to include all pages, even the page that teaches you how to balance your checkbook. Because, and what I always tell people, they're like, but it's blank. I said, but the mortgage company doesn't know it's blank unless you turn it in. You know, they don't know that it's blank. So yes, if it says 1 of 5, you better have page 1, 2, 3, 4, and 5, because your application will absolutely be held up for that. And technically, it's not a requirement for modifications, but it's pretty difficult to show that I can afford a modified payment if your bank account's in the negative. I mean, that is going to play against you. You don't want to turn that in. And also, if you live near a casino, you really don't want to turn in. You know, I hate turning in bank statements that have casino withdrawals on there. And you got to let your people know that the ATMs in the casino print that you're at an ATM in the casino. So warn your clients about that too. When you're doing your finance and your budgeting classes, that the ATMs in the casinos will print that you withdrew this money at a casino. Some tips for de-escalation. Again, we've talked about that you guys are normally the first contact that somebody's going to have with your agency, and they are calling you seeking assistance, and they can be frustrated, they can be distraught, they can be upset. So some things to remember when you're talking to somebody. Beyond the fact that, again, you are the face of your agency. You know, as the AmeriCorps worker, as the first contact that they have, you basically are your agency's face at that moment, and everything they say about your agency is going to be based upon their experience with you. So, you know, if they walk away feeling like you have a wonderful agency, it's going to be because of how the interaction happened with you. Be it right or be it wrong. I mean, that's a lot to put on one interaction, but that's how humans operate. So, always remember to stay calm. The conversation with an upset client, never take it personally. Somebody who is yelling at you or getting upset, you always have to be the calm one, even if they're agitated, even if it's starting to raise your blood pressure. Don't take it personally. Calm yourself down. Pass it off if you have to. Find the Darren of your office, right? Liz Marie. Darren in our office is known to never raise his voice ever. Like, I don't know if I've ever heard him raise his voice outside of a sporting event. So, you know, if there's somebody who you have to pass the phone off to, that's okay. But you don't want to be the person to lose your cool on the phone, ever. The tone and pace of your speech. Understand that how you talk can really affect how people perceive the words you are saying. I don't care if every word coming out of your mouth is appropriate and professional. If the tone of your voice and the pace of your speech is not correct, then you can escalate a situation. Your words can be completely misinterpreted because somebody is not able just to listen to your words. Your tone and your inflection and the pace of your speech completely changes the meaning of everything that you say. So you really have to watch that. You cannot raise your voice. Your tone has to stay low, but it can't be too low to where you're condescending. You know, that could come off very badly. Your pace can't be so fast that you're frustrating the person because they can't understand you, but it can't be too slow to where you appear condescending. You've got to find that middle ground. Sir and ma'am go a really long way. I know those aren't terms that we use very often. I always use them with clients. I'm a big sir and ma'am person. I just think it establishes that power differential. Understand that when clients call you, you're naturally in the position of power because you are the gatekeeper to services that they are seeking. I attempt by using sir and ma'am to shift that power differential, to show the respect and to shift some of the power back to them, that I'm here to serve and that I'm attempting to do so. I may not be able to do so in the way they want, but I'm at least attempting it in the best way possible. And then listen completely. I know that when we know the regs, we know what the options are, we know what we're supposed to be doing, it's very easy to be thinking about your next to reply before you've completely heard what they've had to say. Try not to do that because you could miss something that could actually change your next sentence. So be very aware of that. Also, I would say become very familiar with other resources in your community, because you may not be able to help them the way they want help. You may not be able to provide foreclosure relief, but the fact that they're calling means that there's probably other needs going on in the home. And if you're not able to provide your services, being able to provide referrals to anywhere else for anything else that you hear, that's what listening completely. You may hear them say as they're trailing off on this list of, you know, and I haven't been able to buy groceries and I can't get gas in my car and all of this other stuff. You may be able to add in, well, do you know that you could call this place for food resources? You know, have you attempted this in our community for this kind of resource? So listening to everything and then being familiar with other resources that you have in your community may again be able to make them feel like even if you can't assist, they somehow benefited from calling your organization, that you were able to provide some kind of assistance, even if it's not what they're looking for. Or if it is what they're looking for, but their appointment's not going to be for a week, they have other needs. You know, and if you're able to provide anything in the meantime, it can always just make somebody feel better. Some of the foreclosure rescue scams I wanted to talk about for you guys to be aware of is watch for the bait and switch. This is where the homeowner is contacted by somebody saying that we can help you prevent your foreclosure. All you have to do is sell your home to us, sign over the deed, and then we will take care of it. The homeowner believes that they're signing a new loan that will help them save the home and pay it off, but really what they've done is basically just sign the deed over to the house, but the loan is still going to get foreclosed on. So watch on that. The other thing that we're seeing is phony counseling agencies. There are A lot of these entities from out of state, Florida and California seem to be big. I don't know what's going on in those states, but they have a lot of people claiming to be attorneys and soliciting homeowners across Michigan, and there are quite a few agencies actually in Michigan doing it within as well, but they are soliciting people saying, we can help you complete the loss mitigation application, we can help you file for HAMP and get your interest rate down to 2%, we can, I mean, you hear them on the radio, you know, saying, do you know that you're guaranteed a 2% interest rate, that you can get your modification, get it dropped? One, nobody under HAMP is ever guaranteed a 2% interest rate. That just doesn't happen. If you can guarantee anything, you're lying. I can't guarantee anything. I never guarantee anything when it comes to negotiating step forward, loan modifications, loss mitigation of any kind. Nothing can be guaranteed. These entities also charge. They charge people usually on the average of $1,200 to $1,500 as well for their services, sometimes more. Sometimes they set up payment plans, $900 a month or something horrendous like that. So again, and people feel like if they pay for something, it must be higher quality instead of our services, which are free. You know, there is a little bit of quality associated with price. So sometimes people fall for it just under that basis, that they thought that they had to pay for it to really get, you know, I'm getting the best service. When truthfully, one of two things is happening. Either they're not getting any service and this is a complete scam, or these people are, yes, submitting a loan application for them, but they're doing the same thing they could have done with us for free or on their own for free, and they shouldn't be spending the money for this service. Because there's nothing guaranteed that they're going to walk away with any benefit. Because they're going to submit the application whether or not it looks like it's going to go through or not. We will take a look at it and say, we don't think this is going to go through. This is why. And we should do A, B, and C before we submit it. It is very difficult to correct an application with a mortgage company once one has been submitted, to go back in and to justify why you now need to change numbers, why things need to be adjusted. It's very difficult to undo that kind of thing. Also, mortgage companies have become very familiar with agencies or companies doing this and charging people, which then we can get a backlash from that. You know, when we call and say we're from so-and-so agency, sometimes they don't want to deal with us, or they say, we just want to talk directly to the homeowner, and you have to specifically say, I'm a HUD nonprofit, I'm a MSHDA nonprofit, we're not charging. You know, because they will sometimes think you must be charging them, and they've had so many scams hinder their loss mit that sometimes the mortgage companies are telling the borrowers, don't talk to the agencies, you know, or don't talk to that agency, you know, we can do it, we're going to do it directly with you, because they're actually trying to help the person avoid a scam. So you need to justify that you're not the scam, and that's because there's so many of those people out there. So watch out for scams. If anybody's calling you and telling you that they have paid for a loss mitigation application, that they have paid somebody to assist them, one, they should do an intake at your agency so that they can get real assistance and real evaluation as to what's going on, but they should also be referred to legal aid to see if that company can be sued for any of the money, or at least possibly have a complaint filed with the AG's office, be shut down. We want to shut down as many of those, and the AG's office here in Lansing has been very adamant about shutting these places down in state, and they've done it a couple of times to a couple of the really bad players. So we want to get those people with complaints to the AG's office at legal aid to see if they have any recourse while they're meeting with the counselor, just so we can take a look at that. Another couple of scams, rent-to-own scams. So the homeowner surrenders ownership of the home, thinking they're able to buy it back, when really the terms of the buyback deal are so stacked against them that they're never going to be able to buy it back, and they've already signed over rights. So now, instead of going through a mortgage foreclosure process where they've got this amount of time to do certain things, since they've signed over ownership of the house, they really can just be evicted like a renter and a tenant, which is a very quick process. So that's a scam that goes on once in a while. Short sale scams, and this is where companies promise to expedite the short sale process. If you pay them an upfront fee, $500,000, $1,000, that they will then negotiate with the mortgage company to expedite the approval of your short sale. Any realtor who you're already paying to list your house can do this. You don't need to pay another company a fee to be another middleman. You're already paying a realtor fee. And the realtor fees, understand, if you're ever doing a short sale, I didn't mention this, but when we talked about short sales need to use realtors. Mortgage company wants you to use a realtor, and that realtor fee is going to get factored into the loss that they're willing to take. Foreclosure is right up there with bankruptcy. Nobody's ever going to be able to give you a direct number. If anybody ever gives you a direct number for anything, like this is going to drop your FICO score by 200 points, they're lying. Nobody knows the exact number anything's going to drop it, because a FICO score is generated by so many different factors. It takes into account all of the other lines of credit you have, how long you've ever had credit, the type of credit you have. So a mortgage foreclosure is going to drop your score differently than it's going to drop my neighbor's score if they were going to go through it. But in relation to the spectrum of how bad it is right up there with a bankruptcy in regards to how much it's going to affect it. Because a mortgage is usually, on somebody's credit report, the largest debt that they have. And a mortgage is weighted very heavily because it's considered a very good debt. It's going to help out your credit a lot if you maintain it, and it's going to hurt it quite a bit if it's not. But again, that's relative to other things. If somehow you're able to go through a mortgage foreclosure but maintain other things on your credit good, it will damage you less than somebody to where the credit card went bad, the car went bad, and the mortgage went bad. There is a spectrum, you know, and again, it's going to affect everybody's score differently. And paying your mortgage on time is obviously the best. And the more you fall behind and farther you get down the spectrum, with foreclosure being the worst. A short sale is better than a deed in lieu, but a deed in lieu is better than a foreclosure. And there are separate codes that the mortgage company files with the credit bureau to acknowledge the difference between each of those things that have happened. All right, well, thank you very much, you guys.